I think that interest rates, of course, when the Fed plays catch down on rates to the rest of the world in this cycle, and we always look at gold in US dollar terms, a weaker dollar will help out, even though I said before that it's not really just against the US dollar, but we price everything still in USD. So I think gold's, if you're going to ask me about a price level, and it's next to impossible to model out, but I am bracing for gold to minimally hit a peak of $3,000 in the next couple of years.
In recent analyses and expert insights, there's a growing consensus on the trajectory of gold prices, driven by a convergence of global factors. DavidRosenberg, founder of Associate Research, points out that while ETF flows into gold have yet to surge significantly, the expectation is that such inflows could bolster the yellow metal's upward momentum substantially once they materialize. This sentiment aligns with forecasts suggesting that gold could reach $3,000 per ounce in the coming years. Citi analysts further substantiate this bullish outlook, predicting a surge in gold prices of up to $3,000 over the next 12 months. They cite physical solid demand, ongoing central bank purchases, and favorable macroeconomic conditions as pivotal factors underpinning this projection. According to Citi's analysts, while the path of gold prices may not be linear, they anticipate average prices trending higher in the latter half of 2024 and into 2025. Rosenberg highlights a notable shift in the perception of gold, noting its recent highs across various currencies beyond just the US dollar. This trend signifies a growing recognition of gold as a currency rather than solely a commodity, evidenced by its resilience even amidst rising commodity prices and a strengthening US dollar. This departure from its traditional inverse relationship with the dollar underscores gold's evolving role as a universal store of value and a hedge against economic uncertainty. Moreover, robust retail demand in India continues to buoy gold prices. India's strong economic growth and cultural affinity for gold have increased consumption as incomes rise. This consumer-driven demand in Asia remains robust, despite gold trading at over $2,300 per ounce, up approximately 12% year-to-date and nearing its record high in May. Join us as we delve into DavidRosenberg's insights. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
Well, what's interesting about gold is that it's been making new highs in practically every currency, not just the US dollar. This is not a US dollar story. And then you're seeing, periods where commodity prices go down, gold goes up. The US dollar could go up, gold still goes up. Historically, gold would follow the commodity complex. Historically, gold would be inversely correlated with the US dollar. None of those work anymore. And gold is hitting new highs in practically every currency terms. What's it telling you? It's telling you that gold is no longer being viewed as a commodity. It's being viewed as a currency that is no country's liability. And I think the smart money moving into gold is probably thinking that we're at the peak of the economic cycle. Inflation is going to come down, and this is not about inflation. People talk about gold as an inflation hedge. Well, you can argue that the equity market traditionally is an inflation hedge too. It's really about a couple of things. The first is that the Fed will be cutting interest rates. The longer they wait, the more they'll have to do. And there's a time war, and this is one correlation that has not gone away, which is between real interest rates and the price of gold. And real rates will be coming down alongside with either the recession or near recession. And actually, the U.S. economy is already slowed to stall speed. So the interest rate landscape that lies ahead is going to be bullish for gold. But there's some other, global flow of funds developments taking place. And the big breakout in gold actually started, when the White House, froze those Russian assets. And all of a sudden, you have other countries thinking, okay, if this is the weaponry, we're going to use really financial weaponry in these wars, then who's next? And you've got a situation where central banks globally are reallocating their foreign exchange reserves into bullion. And the People's Bank of China is really the poster child in this regard. They have deep pockets, but that's ongoing. That's not going to change. This is actually part of the economic battle that the U.S. is having with China. China is diversifying out of U.S. treasuries, and they are shifting towards gold. And I don't know the day that's going to end, but it's not going to be soon. On top of that, the other fund flow beyond central banks is the retail demand in India. Very strong correlation between gold and the Indian economy because people in India love gold. If you've ever seen a wedding dowry in India, it's just chock full of gold. And so the retail demand there is ballooning because India not just has a massive population, but it has 9% GDP growth. They have 9% income growth, and a lot of that income is being spent on gold. And look, this is starting to filter through. There's broader participation. You haven't seen it yet, believe it or not. I mean, the ETF flows have not been that strong. That's what really impresses me is what happens when ETF funds start to see the inflow. And now that you're seeing Costco selling gold bars, that's a sign that, and Costco, the folks running that giant retail operation, they know what they're doing.
David Rosenberg asserts that despite recent signs of inflation easing, he believes the Federal Reserve has been cautious in adjusting its monetary policy stance, potentially delaying necessary rate cuts in the future. Recent data from the U.S. Labor Department indicates a slight moderation in consumer price increases, with prices rising 3.3% in the year through May, a slight dip from the previous month. Core inflation, which excludes volatile items like food and energy, also showed a slowdown, although housing costs continue to exert pressure on household budgets. Rosenberg highlights that the Federal Reserve's approach, especially its management of the Fed funds rate, holds significant implications for yields across the Treasury curve. This dynamic affects the relative attractiveness of bonds compared to other investment metrics, such as earnings yields. Earlier in the year, Federal Reserve policymakers had projected the possibility of 3 rate cuts. Still, the central bank has delayed any immediate action, extending the timeline for potential rate cuts until December. Federal Reserve Chair Jerome Powell indicated that the Fed's interest rate outlook is cautiously conservative and subject to adjustment based on incoming economic data. However, Powell's comments following the recent meeting were less definitive regarding the likelihood of a rate cut in September, disappointing some market expectations. Let's get back to the interview.
Well, I think you have to take it into account, obviously, because the most important correlation between Treasury yields is the Fed funds rate. The direction of where the Fed is going is the dominant influence on yields out the curve. And that obviously will have an impact on the discount rate and the comparisons you're going to want to make between bond yields and the earnings yield, which I mentioned before. That math hasn't gone away. So the Fed is very important as far as interest rates are concerned, and not just short-term rates, but the impact it has right out the Treasury curve. And the way I look at the Fed is the way I think we should be treating it, like we should all things. You mentioned Charles McKay's book, which is really all about the dangers of following the herd, especially at extremes. So I think we're at an extreme right now, extreme hawkishness at the Fed. And I want people to remember that, Jay Powell became chairman back in early 2018, and it was all guns a-blazing. And he was going to hike rates, and we're going to go through neutral. And neutral back then was 3%, not 2 5/8 where it is today. And then he hikes rates, and of course comes under intense verbal criticism from Donald Trump at the time. He never gets to 3% on the funds rate. I think we got as high as around 2.5%. And next thing you know, he's cutting rates 3 times in 2019, which you could never predicted when he was super duper hawkish in 2018. And he cut rates 3 times, and that was before COVID. And then we get COVID, we get the lockdowns. We think like we're basically in some sort of Armageddon, and people are talking about, we're not going to get a vaccine for 5 years. We're going to be in lockdown mode and pandemic fear mode to perpetuity. Of course, that didn't happen. But at that time, back in 2020 into 2021, I listened to Jay Powell at his testimonies and his speeches. He sounded like a social worker. And the Fed's never going to raise rates again. He was so dovish and stayed dovish for too long. And then the next thing you know, starting in March of 2022, he embarks on the most aggressive Fed tightening cycle for obvious reasons because of the inflation. Most aggressive Fed tightening cycle since the Volcker years in the early 80s. And in fact, he spent most of the rate hiking cycle comparing himself, not to Arthur Burns, not to anybody else except for Paul Volcker. And Now, the Fed's been on hold. They're dragging their heels. Even though inflation's coming down, they're still not confident. Confident is the word that they continue to use. But I think they've stayed too tight for too long, in the mirror image of how they stayed too easy for too long back in 2021 and 2022. So I'm looking at this as an extreme. And the longer they wait, the more they're going to have to cut. The timing is next to impossible to determine. I mean, at the beginning of the year, the futures market pricing in 6 cuts. Now, with all the verbiage coming out of the Fed, that's been consistently hawkish. We're down to barely more than 1 cut, and not till maybe even after the election. Frankly, I don't care. I'm not a market timer. I just know what the destination is. And the longer they wait, the more they're going to have to do. I think that interest rates will end up coming down a lot more than what's priced in. Probably going to be next year's story. And that'll have a downward pull right across the yield curve. And that's why one of my strongest conviction calls isn't actually cash, which I think has got some very nice risk-reward attributes right now, obviously. But the greatest potential return for the next 12 months is going to be in the long bond.
In navigating the currents of global economic uncertainty and evolving monetary policy, will the resilience of gold as a universal store of value and the Federal Reserve's cautious approach to interest rates lead to sustained market stability, or introduce new challenges for investors seeking stability and growth in the coming years? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.